We are joined now by Jack Ablin. He is CIO, Chief Investment Officer, out at the Harris Private Bank in Chicago, $55 billion under management. Jack, it's always great to have you on. What's your expectation for these earnings coming out after the bell?
Well, yeah, I don't really target individual companies, but I will say that going into earnings season, we had analyst expectations remarkably high. I suppose the good news is expectations for tech earnings have been kind of pared back. So I think that there is an opportunity for these companies, as we've seen in Oracle and some of the others, to actually beat expectations and do pretty well.
Now, I was just asking Teddy Weisberg at Seaport Securities about this volume increase. We had the news that came out of Europe, right, where it looks like they're going to increase the size of the bailout fund fivefold. 25% of the volume suddenly spikes in that last hour. We trade up on that. How do you interpret that increase in volume?
Yeah, I think that's probably news related. Also, last half hour trading has been dominated by flash trading or, high frequency trading. And that's generally comprising roughly 2/3 of all volume anyway. So I think that's, it's just another day in trading, another day on Wall Street, unfortunately.
Jack, Adam and I obviously get a front row seat when it comes to headlines driving the markets. What indicators do you use? Because we know the headlines are not very long lasting in terms of directionally where things are going. What indicators, though, do you follow closely?
Sure. In terms of overall, how much risk I want to take in the market, we look at valuation, certainly. And right now, the U.S. market is still, roughly about 18% below market value, true value over a long period of time. But, there is what I'll call a distrust discount built in. We look at the economic backdrop, and that's generally been a negative as we are slowing and working out all of these excesses. We look at liquidity. Liquidity's been somewhat high, a lot of money supply growth, but the banks aren't lending, so it's kind of an offset, but it's building. We look at investor psychology. Generally only works at extremes, and right now investors aren't panicking. They're not running all for the exits. They're nervous, but not enough to really move that scale. And then lastly, momentum. We broke down in momentum on August 4th. We lowered our risk. We're still holding a pretty high level of cash. And we're looking for some indication to say, okay, maybe things are starting to improve here, and we'll start to add some risk.
Hey, Jack, I know one of the other things you look at, the metals markets, and it's really a tale of two metals. You got gold over the past 6 months up, about 10% versus copper down about 20%. I mean, you can see it on the chart. Look at that split that happened just a few months ago. Explain why this divergence is so dramatic, and not just that gold went up, but that copper fell.
Sure. So really, if you look at gold, copper relative to gold, and I just do it as one relative chart, it's really a pretty good barometer of investors' expectations for the economy. And that indicator started to slip right in March, middle of March, and then just started to slide as we moved into Q2 and Q3. And, it's not an economic barometer. It's a barometer of sentiment. It's a barometer of how investors are kind of playing the investment markets. But it does signify that investors do expect a slowdown, and I'd like to see copper start to outperform gold for me to suggest that maybe things are starting to turn.
I read one of your reports from, I think it was about 5 or 6 weeks ago, and you see a 25% earnings decline for the S&P. That's pretty dramatic. Do you still feel that way?
Well, actually, I had inferred what the S&P, where it was priced, was essentially implying a 25% decline. Essentially, if you take forward PE, and sort of a normal forward PE would be about 14, 15 times, to be conservative. That was the market was pricing in roughly $80 a share for the S&P, which is about down 20%. The interesting thing is that corresponds roughly to a 50% chance of a recession, because if we do end up going in recession, earnings will likely be down, say, 30, 35, 40%. If we avoid a recession, earnings will likely be flat to maybe up slightly. So this 20 to 25% range is kind of the coin flip. And if you ask most economists nowadays, are we going to enter a recession? Most of them are saying 40 to 50%. So I guess it does reflect the skittishness of what's going on in the markets today, and reflects this concern that we could follow Europe in some form or fashion into an economic slowdown next year.
In a moment, I'm going to bring back Jack Ablin. He oversees $55 billion in assets as Chief Investment Officer of Harris Private Bank. Jack, thanks for hanging around. We had a lot of breaking news there in the interim, but it's a good segue into technology and whether or not you think tech stocks are the right place to put your money at the moment, or do you think they're a bit pricey?
I think Lisa, they're a little bit pricey. We do like growth stocks, so we do like the predictability and the somewhat insulation of the growth sector. But I think we would rather play it from the healthcare side, most notably just because they're so darn cheap. Whereas relative to their peers, tech, while it's enjoying some favorable momentum, is probably trading at around 10 to 15% more expensive than its historical relationship with the rest of the market. Healthcare, on the other hand, probably 25% cheap.
Hey, Jack, when we talk about healthcare, we don't usually think about growth stocks, a Pfizer, a Merck, a Bristol Myers, not necessarily growing. So are you focused more on names like Amgen, Gilead, et cetera?
Well, I'm just talking about style-wise growth, meaning that they're more predictable stocks. These are companies that can deliver earnings that are somewhat insulated from the vagaries of the economy. So generally speaking, growth stocks will have, like tech, little debt, very predictable earnings, and historically, investors pay a premium for that certainty, and most recently they haven't. And so, given the environment, it stands to reason that predictable growth is probably more favorable than, say, something a little more levered like finance right now.
Okay, great. Jack Ablin, thanks for joining us. Chief Investment Officer out at Harris Bank in Chicago. He manages about $58 billion. Always great to have you with us, Jack.